Hello, hello. Good evening, everyone. God bless you if you are tuning in live. And for those that catch the replay, God bless you as well. My name is Denzel Rodriguez, your personal finance geek of the 21st century. On this YouTube channel, we cover the velocity banking concept, infinite banking, and kingdom authority. It is my mission and purpose in life to help mothers rediscover the kingdom of heaven so that they can have a life worth living here on earth. They can experience heaven on earth by simply mastering their personal finances on a day-to-day, 10xing your income, 10xing your lifestyle, and really doing the things that you want to do with whom you want to do it with at any point in time, and being an abundant, cheerful giver. Amen. So if it is your very first time tuning in to a live stream, I want you to please comment in the live chat room right now and let us know this is your first time tuning in. So all of my loyal subscribers, loyal clients, kingdom citizens, and myself can welcome you accordingly into the kingdom. With that being said, this evening we're going to be going over the velocity banking fundamentals, okay? We're going to be talking about the steps, the pregame work to take, right? I've noticed that my channel is starting to really grow now, and it's starting to really pick up some steam. Over the last 6 to 9 months, it's really been picking up a lot of steam. And I am starting to see the more of the beginner questions come up again. How do I find a line of credit? How much cash flow do I need? What does my credit score need to be? So when you start watching my YouTube channel, whether you're brand new or you've been watching for a couple weeks, couple months, the most effective thing that you can do is actually join my email newsletter. And I'm going to start sending you some curated emails that basically summarizes my channel in these different emails, so you know exactly how to move forward, especially with the velocity banking concept, figuring out whether or not this is the right move for me at this point in time, or do I need to go back and do debt snowball? Do I need to go back and get my numbers in line? Do I need to go back and fix my credit score? You know, do I have to establish some disciplines first before I visit this, before I put any money into this, any training or coaching or anything like that? So when you are enrolled into my email newsletter, I don't sell, no hard sales. It's not really focused on that right away, because I would rather you be fully prepared before you enroll in anything that I have to offer, and you know exactly what you're getting into. I find it that my clients are so successful when I kind of give them all the information up front in advance, and constantly nurture that relationship in the beginning. And then over time, you do all that pregame work. You establish the financial disciplines, you cut your waste, you increase your cash flow, you redirect cash flow, you increase your income, you get a promotion, you build your credit score. So you're doing all that. By the time you're enrolled in the course, or in anything that I offer, you are that much more prepared, and you're able to kind of like really launch and have a really good positioning when you're looking at these foreign concepts, because that's what these are. The truth is, these are foreign concepts that I am sharing with you guys. And being that they're foreign, they're also very complex in nature. Simple in execution, complex in nature, right? So what I mean by that is, like, comparing the forest, it's like, it's so complex when you look at a forest. So you got trees, you got wildlife, you got the dirt, the soil, you got all these things going on. But when you walk through a forest, it's actually quite simple. It's quite majestic. It's quite, it's very, satisfying and rewarding. And you get the idea of a jungle. You get it. You might get lost, but I mean, if you have a map and you get the landscape of it and you understand where your entry, exit, and what your strategy is going to be going into it, it's pretty simple in execution, right? But it's very complex in nature. So that's what I mean by these foreign concepts that I am going to be sharing with you guys. So we're going to, break it down into different segments. I'm going to show you the whole entire map, right? And I welcome you to drop your questions. Let us know you're here. And we will get this show on the road. And let's see, we've got 22 people in the house so far. Cool, that number will definitely be rising. Let me do a quick shout out to some of you guys that are here. Ramon, hello. Nicola, hello. Johnny, how you doing? Stella from Texas, hello. My first live, welcome to into the kingdom. We got a question already. What's your credit looking like these days after working with Miss Green? Me personally, I am near 800. I'm constantly going down and up where I'll float, like my credit score will drop as low as like 754, and then it'll be as high as like 793, 786. So I'm in between 750 and 795, basically 800, right? So that's where I'm floating right now, and it's really good. Really good. Cruz, what's up, Denzel? Longtime follower. D says, I subscribed some time ago, but first video I watched, I'm not sure which okay? I'm not sure which video to watch first. So, we can definitely go over that. And like I said earlier, the most effective thing that you can do is just enroll in my email newsletter. It's the very first link on all of my videos. Put your email in, and I'm gonna start sending you periodic emails. Roughly, it'll start off like every other day. So you'll probably get a couple emails for the first 2-3 days. And then it'll kind of space out every 3 days, every 4 days, roughly. And then in addition to that, you might get like a broadcast email where I'm like, hey, I'm going live, just want to let you know. Or, hey, here are some updates. Hey, here's what's going on. So you might get some in-between emails. But for the most part, I'm not selling you anything in the emails. It's a very soft sell, nothing hard press, It's not like time restrictive in a sense. It's more so I'm trying to establish a know, like, and trust relationship with you through the camera. Reveal my character, my way of being, my ways of being, my attitudes. And then you are able to make that conscious move on whether or not you're going to trust this 25-year-old kid who's spitting these foreign concepts to you. So with that being said, let's just go ahead and dive into it. Let's not waste any time, right? So the first thing in regards to the velocity banking concept, the fundamentals, for those that are obviously brand new, velocity banking is simply the debt snowball concept on steroids. Call it debt snowball 2.0, whatever you want to name it. The idea behind velocity banking is being able to use debt to pay off debt, use debt to leverage debt, to invest and make money. One of the two is really what it boils down to. So we're either using debt to pay off debt. We're borrowing from Peter to pay Paul. When I borrow from Peter, I get charged a very low cost of borrowing. In many cases, zero cost of borrowing, called offsetting. We are offsetting our borrowing costs by simply paying off a debt that is costing me monthly cash flow and a higher interest rate is the general idea. And what velocity banking does is simply accelerates the speed and direction at which you pay off debt, right? So we are increasing speed in a particular direction in regards to, in many cases that I deal with, it has to do with paying off debt, more specifically paying off bad debt that is hindering cash flow, costing us a lot of interest, so that we can position ourselves to eventually 10x our lifestyle is the end game. The end game is to 10x, in my opinion, which simply means to go from whatever you're making today and just multiply it by 10. If you do that at least once in your life, I can almost guarantee you with 100% conviction, I personally believe that over 90% of your money problems would get solved if you just went from what you're making today and just multiply it by 10, right? And to give you an example, for me personally, when I first started on my 10X journey, I was initially making $2,000 a month. My expenses were $1,500. My debt was just under $30K, and my cash flow was $500. I went just like this, times that number by 10. Within about a year, I was roughly making $20,000 a month on average, and I just kept the same system. So when I 10X, I said, well, why not 10X again, right? So you can do it as many times as you want. I think doing it at least one time will drastically shift your positioning, your thought process of how you view money, which is just a resource at the end of the day. And so 20,000 a month times that by 10, it's now 2021. I'm averaging now roughly 35K a month. And you know, I really can't complain. I've been blessed by the Holy Spirit. I feel sometimes anointed. I feel favored. I've got Jesus as my witness, God as my judgment, Father, and you know, really just aligning with His will for my life, you know, completely surrendering what I think I know about money and surrendering to a much bigger cause. You know, having 35,000 a month on average income coming in really allows me to think big. When I was making 2,000 a month, I was thinking small. But then I just simply decided to 10X, go to 20K, and then not really look back, continue to increase that number. So my cash flow goes from 500 and 2021, you know, I'm roughly cash flowing almost 15K a month, you know, roughly, sometimes more than that, you know, especially if I have a big month. Like if I make a 40K month, 50K month, obviously the number goes up because it's just pure profit at that point. And I'm completely debt free, so I don't owe anybody anything, right? I don't owe any debt, but I do own debt. So I own debt, I don't owe debt, and I debt leverage. And what that simply means is I became Peter that lends to Paul, right? That's essentially what I've done in my life. And there's a particular scripture that talks about how we can lend to many nations, right? And technically speaking, a nation, when you go to the root of it, started by a group of people, right? So nations are people. More specifically, I can refer to a nation as your household, the Rodriguez family, the Eddie family, you know, the Cruz family, the Selvin family, the Johnny family, the Stella family, right? I just simply figure out a way to go from owing to owning. I've replaced the E, put it with an N. I now own debt that pays me money, right? And so what velocity banking allows us to really do is position us for big thinking. Whereas these traditional methods that maybe you were born into or taught really doesn't create a world where we can think big. You know, like I've been taught to get a job, go to college, save your money, max fund your 401k for retirement, and have a Roth and have an emergency fund, and save and scrimp and scrap and preserve. And you know, when you're 65 years old, when you're 59 years old, you'll be happily ever after. I've been told to not talk to strangers. You know, I've been told that a penny saved is a penny earned, when in reality, a penny is a penny. In fact, it's less than a penny, right? It's terrible. So these traditional views of money provided by, say, the system that we live under, when you look at the stats of, say, the average American that followed all of those steps, I have still yet to meet a client that is over the age of 55 that can honestly tell me that they are in love with their 401k plan, their pension plan, their Social Security, their SEP IRA. I have not met one individual yet that is the promoted language, that's the promoted advice that we typically get, right? So as traditional and safe as it is, does it really provide the happiness? And just forget about the happiness for a second. Does it logically provide the resources that I need to succeed in the 21st century? Can we honestly, answer that question? And is it possible to cut a 40-year timeline into about 5 to 7 years to create a life worth living for more than just the last fourth quarter of my life? I would like to live a life worth living in the first quarter, the second quarter, the third quarter, and the fourth, right? And so if I stick to traditional, I don't know, based on stats, statistics, historical data, I don't know if that can guarantee me happiness, a life worth living, financial freedom in that time frame, that whatever it is, 30, 40 years. So I don't say none of that to be against it. To provide full transparency, I still do all of the traditional moves because at the end of the day, they're fundamental. The only thing that I do is I add a little thing that I call 10x, where I multiply over grow. I choose to multiply my dollars as opposed to growing my dollars. So if you have $1 and I have $1, you put your dollar in a location where you're going to get a 10% rate of return. So you're going to earn 10 cents in the first year. You'll have $1.10. The second year, you put in another $1. You're going to earn, another 20, so 10% on top of the $1.10, right? The original principal, $1, you add another $1, you have $2 of principal. You have your 10 cents, your return from the first year, and now you're going to earn 10% on $2.10, whatever that number is. And then you start to compound over a period of time. Whereas me, I take that dollar and I say times 10 in the first year, and now I have $10 at the end of the year while you have a measly 10 cents, which, by the way, you're going to get taxed at, 30, 40%, depending on the political environment that we're in. So you got 10 cents, I got $10. Second year, $1 plus 10, I now have 11. I take that 11, I put in another $1, let's just say, keep it so simple, 12. 12 times 10, $120. It's only a matter of time, right, before I multiply a hell of a lot faster than you compound. Again, I say this not to go against compounding, because at the end of the day, I compound my money too. I have the Roth, I have the HSA, I've got the Bitcoin, the Ethereum, I've got the investment accounts, the brokerage accounts where I'm buying the stocks, the dividends, the index, the cash value life insurance policy. I'm doing all of that. That's where I store the money that I multiplied, and I do everything you're doing as well. Scrimp and scrap and cutting back, I do all of that too. Frugal, I drive a 2017 Hyundai Tucson. It's 2021. I do not have a payment on it. My insurance cost is pretty low, right? So I drive a 2017 vehicle in 2021, right? Instead of buying a G-Wagon, instead of buying a Mercedes, instead of buying a Lexus, a BMW. I redirect cash flow. I recapture transactional costs through debt leveraging, credit cards, cryptocurrencies, blockchain, investing, right? We can go all day with this. So all I want to do is add to what you're already doing by simply putting an X and a 10 times 10. That's it. Think big. We're going to solve a lot of things in this lifetime, my friend. Okay? So let's come back to it. The most important thing you need to know in your personal finances and business finances are these four major numbers. Your income, your monthly net income, your monthly expenses, that is everything. So an expense is everything that leaves your checking account. If you save money, that's an expense. If you invest money, that's an expense. If you tithe, if you give, that is an expense. Your housing, your living, expenses. Your debt payments, those are expense. Everything and anything that leaves your checking account is an expense. So document it. Stop fooling yourself, okay? So you need to know your monthly net income, your monthly expenses, the total amount of debt you have. You could be possibly debt-free watching this. If you are, I still want you to look at the debt that you do have that is at zero balance, right? Which could mean a bunch of different credit cards, a personal line of credit, a home equity line of credit, an all-in-one loan. These are debt leveraging. Maybe it's access to debt where you can go to the bank and get $1 million at any given time or $500,000. That's debt leveraging. Calculate that. If you are in debt, calculate it. Last but not least, one of the most important things that creates financial freedom, in my opinion, is cash flow, right? What is your monthly cash flow? What are you averaging per month? Be conservative so that you can create, so that you can underperform, over deliver, right? So you want to underperform because you want to account for errors, unexpected expenses, emergencies, and things like that. But for the most part, when you know your monthly net income, you know your expenses, you know your debt and cash flow, it's very hard to fool you when it comes to knowing your numbers. So that is one of the most fundamental rules right there. Before you do velocity banking, please know your numbers. I don't talk to anybody unless they give me their numbers. I'm not interested unless you know your numbers. Because at the end of the day, I am not a financial coach. I'm a consultant. I'm a strategist. I'm a specialist. I need numbers. You give me what you're working with, what your goals are, I create the strategy. But I'm not going to coach you because that's not my style. It's not my expertise just yet. So I'm not exactly a coach. I hold coach to a high standard. I believe personally, in order to be a phenomenal expert coach, you need to have 10,000 hours practiced into that craft. So me personally, I have about maybe a good, maybe 2,000 to 3,000 hours of practicing personal finance, right? If that. So I've got a long way to go before I declare myself an expert. It'll probably be about a good 5 to 7 years before you hear me utter the words expert. Although people call me an expert or call me a guru, an influencer, and that's fine and dandy, but I'm letting you know personally from the horse's mouth. Look, I'm not an expert by any means. I'm 25 years old. I've got a lot to learn, but even more to give at the end of the day. So you need to know your four major numbers. The next piece of information you need to know is what your debt tool is going to be. And I wrote down the different debt tools that we use in the velocity banking world. You've got credit cards, both secured and unsecured. You've got personal line of credit, personal secured personal line of credit, so secured and unsecured. HELOC, home equity line of credit, not a home equity loan. Home equity line of credit, first or second position. You have an all-in-one loan, which is a checking account, a HELOC, and a loan all-in-one product, right? And last but not least is a cash value life insurance policy, right? And there's different segments in that as well. but I just want to kind of generally label it cash value life insurance. These are all potential tools that you can use to accelerate debt or debt leverage to invest and multiply your income. So you're going to want to decide, what tool do I want to acquire? And in order to acquire any of the 4 tools right here, you need to have a good credit score. The cash value life insurance policy, we don't need to have a credit score. It's a private account. But these 4 products and up, you need to have a decent credit score. What is a decent credit score? I personally would like to see a 720 or higher. Personally. Now, that doesn't mean you can't get access to any of these tools below 720. What it does mean is you may pay a higher rate. If you are below 720, you might pay a higher rate. And then I can pretty much guarantee you that if you have a 720 or higher, 750s, 800 or more, you're going to get the best rates. The lower rate your debt tool is, the faster velocity banking will move in your favor. So with that being said, recap, you need to know your 4 major numbers. You need to know which debt tool you're going to use. Here are the products right here. You need to have a decent credit score, 720 or higher preferably. Does not mean you cannot get these. But like I said, the lower the rate is on your debt tool, the faster your concept will flow for you. All right. Next thing is the rules of velocity banking. These are rules that I've established for myself personally. There are other rules and other practices in the game, don't get me wrong, right? So this isn't to say that if you don't follow these rules, you're not going to get success. What it does say is if you follow these rules, your chances of success shall increase much higher and will really help you evaluate numbers, okay? So the very first rule is, after you know your 4 major numbers, right? Knowing your numbers. I didn't really put the rules in order, but you need to know your numbers, right? And once you know your numbers, you'll be able to tell me what your cash flow times 12 is in a year. So if it's $500 a month, times that by 12, that's $6,000. If it's $15,000 a month times 12, that is what, $180,000? Yes, it is. Got my math right. It's $180,000 in cash flow. So you can either be as low as $6,000 a month in cash flow. I mean, $6,000 a year in cash flow, as high as 180, whatever the number is, right? Get it, times it by 12. Once you have that number, put it off to the side. The next thing we're going to do is we need a measuring stick. We need a ruler, right? We need a ruler to determine whether or not borrowing from Peter to pay Paul makes any sense. For example, Peter is here, Paul is here. Paul is charging me 1%. I need to pay off Paul. Let's say that's my goal. I have a debt with Paul at 1%. Let's say your desire is to pay off Paul. You go to Peter. Peter's charging you a 10% rate. Does it make sense to borrow from Peter to pay Paul right here? Absolutely not. Absolutely not. But let's flip the script. Let's say I can borrow from Peter at 1% and Paul is charging me 10. Does that make sense? Yes, it does. From a practical standpoint, not even including velocity banking, if all I did was borrow from Peter at 1% to pay off Paul at 10%, my friends, that is a very simple concept called debt consolidation. Right? It's not crazy. There's nothing to it. If you owe $10,000 at 10% and you borrow $10,000 at 1%, you're a winner. You're going to pay off that debt a lot faster if I just stayed with Paul. So I did get debt consolidation. What velocity banking does is simply takes all your income and starts to pay Paul as opposed to just your cash flow per month. So if I showed you a way that you could use all of your income to pay off debt and still live, pay your bills, and do all those things, Obviously, you would say, well, 2,000 is a lot more than 500 a month. I'm going to go faster. Okay? So that is a very simple way of creating our measuring stick. You need a ruler. So the ruler that we use to measure whether or not velocity banking makes any sense whatsoever is the debt snowball concept. What is the debt snowball concept? I simply take my extra cash flow per month and I apply it towards my smallest debt. And I work my way up to the next debt, to the next debt, to the next debt, creating a snowball effect down a mountain where I have this huge snowball into a boulder, right? And it creates a lot of momentum, a lot of speed, a lot of wins early on in the game. So what we're doing essentially is if you are in debt, say $500,000, and you ran the numbers just from debt snowball, you take your monthly cash flow, whatever it is per month, apply it towards your smallest debt, and you go bomb, 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 bomb. You can put it in a spreadsheet or you can write it out. So you literally just, if your cash flow is $500 and you have a debt that's $10,000, the monthly payment is $300. You're paying in total $800 towards that $10,000. $10,000 divided by 800, you'll be debt-free from that debt in 12.5 months. Now, obviously, this will be actually faster than 12.5 months because the interest, the more principal you pay towards interest, that actually, boils down to like maybe 11 to 10 months because you're paying less interest in advance. You're getting away from the interest. The 10,000 was the principal. The 10% is the extra $1,000 on the 10. But if I get ahead of it, I don't have to pay it, which allows you to obviously pay off the debt faster. So you do that, right? You do your debt snowball method. You run the numbers. You check it out. And then you get an overall statistic saying, okay, in order to pay off $500K doing debt snowball, I'll be debt free in 10 years, right? And that's almost as guaranteed of a number as you can get. The only thing that would harm this in a negative way is if you lose your job, have an emergency, unexpected expense, vacation, holidays, birthdays, right? This is why people don't get out of debt so fast. So it actually turns into 12, 13, 14, 15 years to get out of debt. But still, it's a lot better than 30 years, correct? So debt snowball can typically bring you 50%, I want to say about 50% faster if you just did nothing, right? If you compared nothing, just paying the monthly minimum payment on everything, versus debt snowball, you could definitely go at least 50% faster, no doubt, in my mind. So let's say 10 years was the mark. All velocity banking needs to do is beat it by 10 years. But we don't just want to beat 10 years by, say, 6 months, right? Or 1 year, because that's not big enough of a window to convince, say, me to do velocity banking. Although 12 months is a lot better, right? 9 years is better than 10 years, no doubt about it. So I would still probably do the one that goes faster, but I want to make sure I improve what that alternative is, because I desire to go fast and be very effective. So ideally, I want to go at least 30 to 50% or more faster than my measuring stick of debt snowball. So I want to be done in like 5 to 7 years. That's a big difference. 3 years, 36 months, 5 years, 60 months faster without any change in the numbers itself, right? That's what you need to pay attention to, is take away the 10x, take away increasing your income, take away being frugal and all that stuff. Just go off what you're currently operating in today, run the numbers, both debt snowball and velocity, and see where you end up. And then you add being frugal, cutting back, increasing my income, getting a promotion, redirecting cash flow, recapturing costs, right? Because those additions into your personal finance, you could do with either strategy. So when you're listening to somebody that promotes Debt Snowball, or you're listening to somebody that promotes velocity banking, you want to make sure that they're basing it off just the current numbers. Because if they use being frugal, cutting back, right, and all these little things, well, I could do that as well. So we don't want to use that as a persuasion tool, as a sales tool to maybe keep someone from doing something, right? Because I can do what you do, if not better, right? So we don't want to, stay stuck in that way of thinking. So that is our measuring stick. So you need a measuring stick. What's the measuring stick? Debt Snowball. Got it? The next thing is, in addition to grabbing your main debt tool that you're going to acquire, you're definitely going to want to have a credit card to pay bills that comes with cash back rewards. Say, for example, you're somebody that has a HELOC against your property. And let's say that's your main debt tool, right? In addition to having this HELOC, you also want to have a credit card that has anywhere in the neighborhood of 1 to 3% cash back, and sometimes there's some as high as 5%. And I've got cards that go higher than that too in the crypto space. But the average that I see is 1 to 3%. You can definitely get 2 and 3 very easily with a lot of different credit cards. And so you want to have a credit card to pay or to run most of your bills. You want this credit card to be at a zero balance, preferably, right? So let's say you found a card at 3% cash back on everything, right? If that's the case, then, more realistically, let's go with 2%. 2% cash back on everything. Let's say you've got $4,000 worth of bills each and every month, and these are bills that can be paid with a credit card with no fees. So every single month, you're earning $80 on money that's already leaving your economy. $80 times 12, that's $960 back into your economy. That's $960 that helps you pay off debt that much faster. In the Debt Snowball world, you can't do this. This is not what they teach, right? So just by doing this, I now have something over Debt Snowball that they can't do, right? Because they don't teach that. They teach you to go like this to cut the credit card. You have to cut all your plastic. That's what they teach you. Cut them up. You pay them off, cut them up, and you close them, right? So this is $960 that allows me to go faster than Debt Snowball. Do 960 times 5 years. That's $4,800 additional that I'm able to put towards paying off debt. So that alone, I can beat you in terms of Debt Snowball versus, say, velocity banking. I'll beat you just off of that. And then a lot of these credit cards come with a statement credit. Spend $3,000 or more, spend $5,000 or more, and get $200 back. So in addition to the 48, add another 200 for spending X amount of dollars. Now I'm at 5,000 total, right? So you want to have your main debt tool that you're going to use for velocity banking. You want to have your sub debt tool, which is a credit card that you're going to run your general monthly bills religiously. And then another really cool slick move, which I love to do, is I go and get a credit card at 0% for at least 12 months. Yes, could go higher, but at least 12 months. These are not difficult to find. And I find a credit card at 0% for 12 months on purchases, right? Now, the 0% for 12 months on purchases, I then look at my expenses that can be paid with a credit card with no fees, and I target all of my bills that can switch from monthly to annual, right? So let's say you've got $7,000 worth of bills that you religiously pay every single month, no matter what. It's the same 7,000, of bills that you're going to pay every single month. It ain't going nowhere, right? Now, in that 7,000, you've got, say, 20 different bills that you pay monthly in the 7,000. So let's say you got 20 separate bills that you pay religiously every single month, $7,000, right? Well, of the 7,000, which is divided up into 20 different bills, let's say you've got 10 of them that you could switch to an annual payment, right? And I'll just keep the number the same because, you're switching it up or whatever. Let's just say with the 10 bills, if you paid it annually, you could save an average over those 10 bills. You could save about 10% just from switching from monthly to annual. You could save 10% on these specific 10 bills. And let's say that total equaled $10,000, right? So if the total on the monthly spectrum was $10,000 and you're telling me I can save 10%, that's $1,000. Yes? So that means my net output, if I switch from monthly to annual, is actually $9,000, right? So what ends up happening is you can delegate certain bills that you're going to pay monthly that cannot be switched to annual through this one card, and you're going to get your cashback rewards, roughly 1 to 3% or even higher than that. And then once a year, every year, you'll apply for one credit card, 0% for 12 months. You'll switch from monthly to annual. You'll save an additional $1,000. And then what you'll do is you'll pay the minimum monthly payment for 11 months. And then when the time comes, you'll pay that off in full on the 12th month. Why do we do that? Because it's at 0%. It's not costing me anything to carry the debt for 11 months. It's not costing me anything to do it. So I'm simply pushing the bill, getting cash back or savings, $1,000, cash back rewards, roughly 1 to 3% or higher. Doing these two things alone, my goodness, I am ahead of you by quite a bit. That's 1,000 times that by 5 years. That's another $5,000 that I can be throwing towards debt. Okay? So the rules, recap, know your numbers. 4 major numbers. Pick your debt tool. Need to know your credit score. Cash flow times 12. Haven't discussed that really yet, but you need to know what your cash flow times 12 is. We went over your measuring tool, which is that Snowball. We went over the additional tools, credit cards to pay bills, get cashback rewards, switch from monthly to annual to simply save a bunch of money. Now let's go into the 66% rule. Let's say you've got a HELOC at $50,000. Okay? This is where debt leveraging comes into play. And I say, all right, 50,000 times 66% is 33,000 bucks. So I have a personal rule when it comes to leveraging debt, which is I will not go over 66% leveraged on my credit. And I have a couple of rules that can violate that sometimes, but majority of the time I will safely leverage 66% to chunk. What are we chunking at? Typically we're chunking at a bad debt. I'm borrowing 33 grand from Peter to pay off Paul, right? When I borrow from Peter, let's say I'm paying 3%, I pay off Paul, who was charging me 7, 9, 12, 15%. I consolidate. I still owe 33, but now I'm paying 4%, 5%, 6%, 7% less in interest. And then I'm going to do velocity banking. All my income will go into this main debt tool. When I go to pay my bills, I've already delegated and allocated what is going to be switched to monthly, what bills are going to go through this main credit card. That allows more of my income to sit in the main debt tool, which is also lowering my borrowing cost. And then when you do the overall math, we go from paying 3% to actually paying 0 because we offset it with cashback rewards, switching from monthly to annual, dumping all income in, reducing the actual rate that I'm being charged on a daily basis. These are all things you cannot do in the debt snowball world. And if we just did these things, I will beat you than if you just made extra payments. You cannot refute that. These are facts. Now it's a matter of the application, the execution, right? I'm telling, look, this alone is complex in nature, pretty straightforward, simple in execution. Once you get the complexities of it, once it clicks, after you've watched so many videos, it'll click and you'll be like, oh my God, where have I been? Where have I been? Right? So these are the rules. And to go over what would make me violate the rule. So coming back to this, cash flow times 12. Let's say your cash flow is 15,000 bucks. That's 180,000 a year. If I only have a $50,000 debt tool, I'm going to be very comfortable chunking more than 33,000, right? So the rule is, to violate the rule, is if your yearly cash flow is more than 66% of your main debt tool, then you can chunk equal to what your cash flow is in a year. In some cases, maybe the whole amount, because you're a high income earner and maybe your credit's just not that great. And so over time, we can obviously get increasing limits to bring it to, 100, 150, 200,000 so that we can balance out the leveraging. But that is the only rule to violate the rule. Now, why is that important to know? Because if you're doing debt snowball, right, it's based off your cash flow. So if you're cash flowing 15 grand a year, you can only throw a max of 180,000 towards your debt. Does that make sense? Or if you're cash flowing 500 bucks, you can only throw an extra $6,000 towards your debt. And then anything that you gain from that 6 grand that you pay off, that's additional cash flow that you factor into the equation. So in order for velocity banking to actually go faster, we need to chunk more than what your cash flow is times 12 to actually go ahead of Debt Snowball, right? Now, we went over the rules, the pregame work, went over a little scenario, we went over the debt tools. Now I want to go into finding the debt tool. How do I acquire what I need to eventually implement this complex concept, which is simple in execution, right? How do I go about doing that? Now, again, if you click the very first link in all of my videos to join my email newsletter, you will get sent a playlist that goes over, eventually you'll get the email. It'll specifically go over the who, what, when, where, why, and how to find a debt tool. That's free information. Some people charge thousands of dollars to get access to that information. Denzel is doing it for the free. The issue is you have to take the time. That's the issue. You have to spend the time to watch the material. So, some people will do it, some people won't, some people will procrastinate, and that's why you'll stay in your measly $2,000 a month, $3,000, $4,000 or $5,000 a month income, and you'll never reach higher potentials. And by the way, this is not a lot of money. 20 grand a month, 35 grand, that's not a lot of money. That's enough money for one family, but it's not enough money for 25 families, 25 households. See, I think more than just my own household. I am thinking about the kingdom. A kingdom is comprised of multiple households uniting together for a higher purpose, a higher vision, a higher value, a stronger brand mission statement. I can't stay small. I can't think small. I can't think small to wealth. It's impossible. You're going to be disappointed in the end when you're 59 and a half and you can only take 4 vacations a year, or 2 or 1, and they can only be on the holidays or the kids' birthdays. You can't just take a vacation just because it's a Tuesday, right? You don't want to have that frustration. So in regards to finding the debt tool, the first thing that I do is a Google search in my area. That's the first thing. Google search in my area, 25-mile radius, okay? I'm going to search local credit unions. That's what I'm going to search. Local credit unions. I can then type in state credit union. I can type in federal credit union. I can type in nationwide credit union and go on a hunt in my local area. I start there first. I then will make a list of all the banks that I find. Again, this is free information. The problem is you got to go do the work. That's the problem. That's the variable. Will you do it? I don't know. That's not my problem. I've already done it. For me, for my clients, right? In my course, it's already there for the most part. You know, I try to go state by state and I try to give you the tools, but listen, like that good old saying, bring the horse to the water. You can't force him to drink, right? So with that being said, I type these things in. Google will pop up results, 25-mile radius. I start writing down the list of banks, okay? Once I got my list, now it's a matter of process of elimination, okay? What you are going to do is visit the website. of each and every bank that is a credit union. Okay? You're going to visit their website. You're going to click on the tab that says loans, right? Or it might say borrow. Okay? Anything that says borrow, loans, personal loans, right? You're going to click on that because you're looking to see if they offer these tools right here. An all-in-one loan is an exclusive product. You're not going to find that everywhere. You have to go through a proper source first. The only source that I know of so far is called cmgfinancial.com. That's the only source that I know so far. There's probably more, but that's the only one that I know so far. So you're not going to see that promoted anywhere from all the banks that I've looked at so far. So that's why you're going to see just this. And even these are not as easy. You know, the credit card is the easiest one that you'll obviously see. Okay? So with the credit cards, pretty straightforward. You're looking for 0% on purchases with cashback rewards or maybe points. That's what you want. When it comes to a personal line of credit, secure personal line of credit, HELOC in the first or second position, you are looking for the proper terminology. You want to make sure it says line of credit. Okay? These are the most important words right here of these two products. Line of credit. Right? Line of credit. Very, very important. You don't want to get confused with a loan from a line. You don't want to apply for a loan because you cannot do velocity banking with a loan. It won't work. You need a line. You need a revolving, it's another key word, revolving line of credit. It needs to be revolving. Okay? Very important. So as you visit the website, you click on loan, borrow, and all you're going to do is if you cannot find line of credit, revolving, you cannot find these tools, right? You want to start separating the list. Banks that offer it, banks that don't. Banks that offer it, banks that don't. Create your list. You start process of elimination. What you could do is if you don't see line of credit revolving, you can stop and just find the number and call. Call the bank and ask, do you currently offer a personal line of credit, secured or unsecured, a home equity line of credit in the first or second position as of 2021? Are you currently offering that product? Yes or no? You get a no, cross them off the list, keep searching. You get a yes, okay, put a star next to that bank and you say, all right, I'm going to come back to you. And you go through all the banks. Once you know which banks are actually offering what we want, then we're going to do the next steps. But until then, all you needed to find out is if they even offer it. Because if they don't offer it and then you start asking, hey, what does it take to get a proof of this and what credit score do I need and blah, 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 you're wasting your time. You're wasting your time asking about what the requirements are, trying to build a relationship. You're wasting your time. You need to find out if they offer the stuff in the first place. Okay? So, call the bank, make your list, separate the list. You want to do, say, 3 to 5 banks. 3 to 5 banks before you stop your research, right? You want to have a good amount of options, okay? Hope you're taking notes because I'm going to be erasing, but you can also rewind, right? And go back and come back to it. So, 3 to 5 banks, right? Once you have the known banks that offer what we want, now it's a matter of competition. So you're going to start asking what the rates are. Some banks display their rates, some do not. Some display them, but you have to like click a bunch of buttons to get to it. And there is a tab called Rates in many of the banks, and it'll show all of the products that they offer from borrowing and lending. And you'll see the different rates. So you want to ask what the rates are. Okay, very important. Now it's a matter of finding the best debt tool amongst these 3 to 5 banks that you discovered. Okay, you find the rate that is the lowest one out of the 3 to 5 banks. Right, so you can immediately eliminate everyone once you find the lowest rate according to the debt tool that you're looking to apply for. If you don't have a home, or if you don't have enough equity in your home, cross out HELOC. No need to even waste your time on that. Look here, personal line of credit, secured line of credit, and credit cards, right? Or what you can do is think long term, and you can find a bank that does have both, so you can stay with one bank and continue to build that long-term relationship, okay? At the end of the day, when it comes to rates, I don't think you can really go wrong, like terrible. For the most part, a lot of the credit unions are similar in rates. I will say this, as of 2021, if you're applying for a PLOC, anything below 10% is a good product in my opinion. If you find 7% or lower, that is phenomenal. That is a great rate. 7% or lower. 10% or lower, okay, cool. If it is between 10 and 13%, you're pushing it. You may want to scale back, maybe do that snowball before you apply for that, okay? Anything that's 15%, honestly, if it's 13% or higher, you don't want it. Too high, you're not gonna be able to do much damage with that, right? Not worth it. Not worth getting an inquiry on your report for 15%, okay? So that's for PLOC. Anything below 10% is pretty good. You get below 7, I'm like, damn, what's the name of that bank? So I can put it in my course and you know, share that with my clients, because that's pretty cool. HELOC. Honestly, anything below 4% right now is awesome. If you get 3%, you're freaking cool. If you get below 2, you're amazing. Or I mean, if you get below 3, you're amazing. Between 3 and 2, you're killing it. You're killing it. You can't tell me you're not going to go faster than velocity banking at 2% or 3%, right? You're going to be doing big moves. So those are the rates that you're kind of ideally looking for, right? And that's a good thing to know. So you know your range. You look at the rates. Now, once you found the bank, you called them, you asked them, found out which one's got the lowest rate. Now you ask about the requirements. What are the requirements when you're on the phone calling the bank, right? The manager, hey, can somebody talk to me about the home equity line of credit, the personal line of credit, first or second position? I want to know all the requirements needed to get approved for this specific tool, right? So, typical requirements, credit score. They want to see a certain credit score. Every bank is different. This is why I'm not giving you certain numbers, because every bank is different and they're always changing their rules up. So, credit score is important. Are you a member? So these two are like right together. Establishing a relationship. What does that mean? Becoming a member at the bank. You have to open up a checking, possibly a savings. Okay? So before you apply, once you've gotten all your information, all the requirements needed, right? And you feel comfortable, and you're like, okay, this is the bank I want to go with. This is the best rate from the research that I found. You then become a member at the bank. You open up a checking and a savings, and I would redirect all of your income to that bank for a period of time to establish a relationship. You dump your savings into that bank. You move your paychecks into that bank. You set up bill pay. I would give this a 3 to 6 month window before you even apply for the tool. At most, 3 to 6 months at most, okay? They're gonna ask, you're gonna need to know what credit score is required, right? Now here are some, in terms of the tool, the product itself. Once you find a good rate, you know the credit score, you start, before you become a member, you also wanna ask about the functionality of it, right? So I didn't mention that over here, but really, how does the tool function? You want to make sure that what you're reading matches from what you apply to. For example, it needs to be revolving, okay? You want something that is open-ended for at least 5 years or more. Because typically, doing velocity banking, we can get out of debt within probably 5 to 7 years or less doing velocity banking. The revolving part separates a loan from a line. Okay, that's the most important part. Open-ended means the term. How long will it be revolving for? You want 5 years or more. Typically with PLOCs, I'll see as low as 3 years or 5 years, which is fine. You can always just renew. Okay, so you always want to make sure you renew, and when you renew, you want to make sure your balance is at 0. Okay, so if your HELOC is going to expire, you're in the 5th year and you want to renew it, make sure it's at 0, and then ask to renew before the date even expires, and they'll maybe prolong the period. Okay, so open-ended for 5 years or more. Now, another very important thing is restrictions. Are there any restrictions in regards to the tool itself? For example, in Texas, it's very common with HELOCs that you are only allowed to withdraw $4,000 at a time. So you have to withdraw $4,000 every time you want to pull money out of the HELOC. That's not the most ideal situation. There's a way around it, of course, and I've got a strategy to that. But me personally, I don't want a limit as to how much money I can pull out of my debt tool, right? I want the limit to be at least like 50 to 100 bucks. I don't think you can get around that. I've never met one where you can just take out $1. I've never seen that. We're not really taking out $1, but we're also not really typically taking out $4,000 at once. Now, why is that? Because we want to keep our money in the tool for as long as humanly possible, okay? To, again, reduce the interest cost of borrowing. We're trying to offset that big time. So usually those transaction limits are $50 to $100, like minimum that you have to withdraw when we go to do velocity banking and use it. But I don't want a high restriction of $4,000. That can be quite annoying, tough, don't like it. So revolving, open-ended, 5 years or more. Typically with PLOCs, they're as low as 3, maybe 5 years. Some PLOCs are just open-ended, okay? The next thing you can ask is with the HELOC and PLOC is if it comes with a card. This is really cool. If it comes with a card, like literally you'll have like it'll be like a checking account, a routing number and all, where you can directly deposit from your income, your job can direct deposit to your debt tool. These are some of my most favorite debt tools because now it automates the process of me putting money in, taking money out, putting money in, taking money out, putting money in, taking money out. If I'm able to send my income directly to the tool, that saves me time. And if I'm able to pay my bills directly out of the tool, that saves me even more time because I can just set up auto pay. That's cool. Those are my favorite ones. Now, for the most part, for all the other tools that do not come with a card, that's okay too. Not the end of the world, right? Not the end of the world. All you have to do is link your checking to the debt tool, right? You link your checking account to the debt tool. Denzel, what does it mean? Whoa. What does it mean to link? It's just a word. Don't get crazy on me, okay? All it is you want to make sure your income is going to that same bank, right? That checking account that you set up is at the same bank that you have your debt tool. So when you log into your mobile banking account or on the desktop, you're going to see your line of credit. You're going to see your checking account. When you have your checking account, you can do what's called a transfer, right? You can transfer money. Very simple. Not hard work. You transfer your entire check to the debt tool, and then you do a fantastic thing called a withdrawal. Transfers and withdrawals. Money going in, money coming out. Money going in, money coming out. These are for the people that do not get the card with the account and routing number. This is your alternative, right? It's a little extra work, a little more steps, nothing crazy, pretty straightforward, okay? So when you're looking at the restrictions, you want to make sure, you want to ask about these things. That'll help you, okay? Let's see. I want to make sure I'm not missing anything. Now, a big one is the actual application process that people get scared on. So once you've done all the work, all the pre-game work, you go to apply. I need you to read the agreement. Very important. Read the agreement before you accept. It's very important. Read it thoroughly, okay? Because sometimes with HELOCs, another restriction is they say you have to pull out 25 grand upon opening the account. Now, I don't want to pull out 25 grand if I'm only making $500 in cash flow a month. I don't want to be restricted to that. So I don't want to have that restriction. Sometimes they'll say that you have to pull out a certain amount of money. Or they'll say you have to pay off this bill, that bill, that bill. That may not be the best bills to pay off, right? So we don't want those restrictions. Read the agreement before you accept. They may tell you something over the phone, but then on contract, the game changed. So you want to make sure. In addition to that, some banks will say, okay, you have to pull out 25 grand and then we're going to pay off this, and this for you. And you have to keep the 25K owed for 3 months. So you can't pay us back. You can only pay the regular payment. If you pay it back in full, you'll be penalized or something like that. I've seen things like that before. That's not what we want. So say, for example, this option was the lowest rate option, but it had these restrictions. I would say no and go to the other bank. So that's why you do all of this stuff before you apply, before you move all your banking and all that stuff. You get very educated so you don't get stuck in the mix. Right? Very, very important. So when you're applying, right? I can't believe I erased it. Read before you sign. Then they're going to ask you why. It's a very important question. Why do you need this? Or they'll say, what do you need the line of credit for? Okay. Me personally, I have always stuck to the word cash flow. I'm using this line of credit to increase my cash flow, reduce expenses, consolidate debt. Don't say velocity banking. You're going to give them, they're going to look at you with three heads and be like, what? Don't say that. Say the traditional terms. You have to speak their language. You say, I'm looking to consolidate debt, which is going to reduce my expenses, which is going to increase my cash flow. Say, lower my interest rate. So I'm looking to increase cash flow by consolidating debt that I have, which is going to lower my overall interest rate, which is going to reduce my expenses, which is going to increase my credit score. Increase credit score, build credit score. These are all green flags. If you say it like this, why do you need the line of credit? I am looking to consolidate debt that I have, which is going to give me a lower rate. The HELOC has a rate of 3%. I looked online. All of my debts right now are at a higher rate, so I'm going to lower my rates on my debts by consolidating, which is going to increase my cash flow. It's going to reduce a lot of my expenses as well. And this can really help me increase my credit score and really build my credit score for the long term. You tell that to a loan officer, they're going to be like, well, damn. And if you build a relationship with the loan officer, he or she, right? And you connect with them, make a joke. Ask them how their day is going. Ask them how's life, right? Be conversational with them. They will want to help you, right? Because once you make the application, it goes into underwriting, right? And when you underwrite something, right, there's a person. There's still a person. So before it hit the computers and stuff, there's still a person that's going to review that. So when you apply for something, sometimes with credit unions, there's a section in your application. Sometimes they have something called notes. And in the notes, you can have your loan officer put all of this great information in the notes. The underwriter is going to see that. Maybe the loan officer will talk to the underwriter and say, listen, we have a long-term client here. We want to take care of them. They plan on moving their business accounts. They plan on moving money to us. This is the part about thinking long-term. Very effective things. That's one of the most important questions. Why do you need this? Sometimes that can make or break your application when you say something not so smart. Like, oh, I'm going to use this to do velocity banking and I'm going to 10x my income and I'm going to start a business and I'm going to invest. These are red flags. They're going to be like, whoa, 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 whoa. What is velocity banking and what is 10x and you're going to invest using debts? No, we don't want that. That's a red flag, ladies and gentlemen. So you have to speak their lingo, speak their language, talk traditionally. So you have to be able to, you have to know when to turn the switch off, turn it on, right? What we're doing here is a culture that we're creating, a way of thinking, an untraditional, foreign way of thinking. This is how the banks think. But they don't want their customers to think this way because they'll establish their own banks. And then they move their money out of their bank into the Bank of Rodriguez, the Bank of Stella, the Bank of Johnny, the Bank of Selvin. They don't want that. So you have to be aware and be able to speak their language, get what you need, and go. Have a nice day. So that is everything that I know in regards to obtaining a debt tool, the main things that you need to know. If you get on my email newsletter, you'll eventually get an email from me that talks about, velocity banking pregame work, how to find the who, what, when, where, and why of lines of credits, and how to get approved and all that good stuff. All right. That is the end of my lesson. Now what we're going to do is we're going to look at some Q&A. We're an hour and 20 minutes in. I am going to scroll back to the top where I left off. G-Man says, hey there. Cruz, 715 credit score, up 100 points from last year using velocity banking with my credit cards. Awesome. Living well. Hello, Denzel from Canada. Welcome newcomers. Cool. Jonathan, hello. Question. I have a mortgage of $153,000 at 4.45% interest. Can you give me an example doing velocity banking? My income is $8K, expenses $3, cash flow $5. What I'm doing now is paying extra to mortgage. Okay. So, $153,000, right? Income, 5K. Expense, 3K. Debt, 153K. We're going to assume that Jonathan's only debt is 153K. That's the only information that he gave us. So I'm going to assume that's it. All right, I'm looking through the comments. I'm not seeing anything. All right. Let's go back up. Yep. Cash flow is $5,000. Currently, he's doing debt snowball. Wonderful. So he's already making progress. First thing I would do, get your debt snowball timeline. How long is it going to take me to pay off $153,000 if I pay $5,000 each and every month towards the debt? Okay. Measuring stick. Do that first. Then we need to decide what the debt tool is. If I make $8,000 a month, oh shoot, go like that. If I make $8,000 a month, spend 3, cash flow 5, times 12, $60,000 a year is what this person is supposedly cash flowing per year, right? I'm pretty sure this person's living well below their means, right? So $60,000 a year, that's the most amount of money he can throw at debt. We don't know what the mortgage payment is. 153 divided by 60,000 in principal, 2.55 years, right? In reality, that 2.5 is probably more like 2, right? When you add the payments, whatever the monthly payments are. It's probably more like 2 years or maybe even less. So here we have an interesting scenario here. The only way velocity banking will make sense for this gentleman is definitely not with a PLOC, personal line of credit, or secured personal line of credit. Definitely not. Won't work. The interest rate too high. He's at a 4.4% rate. So all we have to do is replace the 153 with a first position HELOC, maybe. So there are, this would probably be the first thing I might do if I was in his position. So I probably would get a first position HELOC, and you can get an introductory rate I've seen as low as 1.99, 2.99%. So if you've got good credit, you can get an introductory rate on a first position HELOC for the first 6 to 12 months, right? So imagine going from 4.4 to 2.99 or 3, anything below 4.4, without having to pay refinance costs. So no closing costs. There's HELOCs that exist where there's no closing costs. Maybe there's an annual fee. Those are typical. But I'm perfectly okay with paying that if you're telling me that I can drastically reduce my rate almost by 2 points, right? Not bad. A point or higher is awesome in a refinance move. Typically, that's usually what they say. So if you go, a point or higher, going from 4.4 amortized to 2.99 simple interest, first position home equity line of credit, this is a really, really, really cool way to simply implement velocity banking. And this is, when you have a first position HELOC, Jonathan, this is completely automated at this point. You can set up your income, your $8,000. You can set it up to directly be deposited into your HELOC. You can set up all your expenses to come out of the HELOC. And guess what? With a first position HELOC, your payment, right, is your paycheck. So technically speaking, you're not going to have a payment. Also, your mortgage payment will reduce because you go from paying 4.4 to 2.99. So if your desire is to pay off your debt first, let's say that's your desire, then you cannot refute this right here. This is irrefutable truth. I can't get around arguing how you could possibly go faster than me with your $60K a year at 4.4, because I'm doing the same thing you're doing, making extra payments, but I'm actually making $8,000 a month payments into your HELOC. And you want me to add some more juice to it, Mr. Jonathan? Go get a credit card. At 0% on purchases, switch from monthly to annual on your bills, cashback rewards. Have another credit card that you run other bills through on a monthly basis, more cashback rewards. That adds more juice. And so we can go from maybe a 2-year time frame to probably 1.5 or even less. Who knows, right? It depends on how much money you make. Maybe you cash flow more, cash flow less. Debt Snowball and velocity banking in this particular scenario, they're very tightly close. They're pretty close. But if you're talking about, okay, well, which one's the fastest? I can probably go at least almost a year faster. Almost a year, maybe a good 9 months, almost a year faster than whatever Debt Snowball can do, right? Because all I'm doing is replacing the entire 153 to a lower rate, lower payment, do velocity banking, dump all income in, attach a credit card to it, 0% cashback rewards. My friend, that's irrefutable truth right there. So I hope that helps. All right, I'll do like a couple more questions and then I'm going to wrap up. Shifting the paradigm. Deuteronomy 28:12. What does that say? Let's look it up. So while I look that up, let me look at these other ones. Tim says, love these live lessons. Cool. All right, my Bible app is tripping. Come on, man. Hi, Denzel. Thanks for all that you do. Velocity banking works great. Started 16 months ago. Paid off 50 grand since then. Mortgage is what I have left. That's what I'm working on. Wonderful. All right, so let's go to Deuteronomy because that's Old Testament. 28, verse 12. And Jehovah will make thee plenteous for good in the fruit of thy body, in the fruit of thy cattle, in the fruit of thy ground, in the land which Jehovah sware unto thy fathers to give thee. Jehovah will open up unto thee his good treasure, the heavens, to give the rain of thy land in its season, and to bless all the work of thy hand, and thou shalt lend unto many nations, and thou shalt not borrow. So here is a almighty, all-knowing, all-powerful being called Jehovah. He goes by many names. And he's saying to kingdom citizens, no need to borrow, my friend. Why not just own the debt? Go from owing to owning. Why not? Why not? Why not? Congrats, Cheryl. Thanks, Tim. Okay, I've been studying your videos all day. So lucky to catch live. Good vibes. Cool, cool, cool. Hello, Denzel. Been watching your videos for weeks. My husband and I feel we are ready to join the manifesto. Wonderful. Looks like we got 64 people in the house. This is awesome. We've been working on our credit score since January. Just joined your Facebook page today. That is awesome. Do you still encourage using plastic? I don't think I ever really did. I just made maybe a couple videos about it. I think there's a place for plastic. There's a place. Plastic used the right way is a good debt tool. Or I should say a good service. It's not really a tool. It's not a debt tool, plastique, right? Plastic, whatever it is. So it's not exactly a debt tool, but it's a way to pull cash out of credit and pay a lower fee. In many cases, it's better than doing the traditional balance transfer. So say your balance transfer fee on a credit card is 4%. But at plastic, it's 2.5. So you are saving money. And then it runs through the card as a purchase. So let's say you're getting 3% cash back on an online purchase. You run it as an online purchase. You actually net a 5%. You go from paying 4%, now you're at positive 0.5%. So that is a winner-winner chicken dinner. Okay. Hi, Denzel. You are God sent. Came across your channel 8 months ago. I was almost 40K in debt. Started Velocity Banking. Paid over 20,000. I will be debt-free and on my way to building wealth by the end of 2021. Love it. Velocity Banking works so well in the business world. Love it. Jerry says, where have I been? AFCU in Salt Lake, good credit union. Okay, cool. Schools in Sacramento offer 25K line of credit, 70/20 credit score. Here we go. Can I get my line of credit limit higher? Yes, by simply calling the bank and asking, do I qualify? What are the requirements to get approved for a higher credit limit? Do you offer higher credit limits on the line of credit? Some banks will allow you to apply, but if they're not even offering a higher credit limit at the point in time, then you just wasted an inquiry. Most of the online banks, Prosper as an example, sends a ton of mailers, but when passed, they are just a loan. I agree. Just request a credit line increase every 3 to 4 months. Yep. Most banks max between 15 to 25. They offer more to businesses. That's true. They also have a limit of how much they can increase. My credit union does 5K increases. Yep, that's true. I talked to someone today from CMG Financial. I'm here in Dallas, Texas. You can only get the AIO loan only if it's an investment. You can get one on your primary. You can get one on your primary property. Do you mean you can't or you can? I want to say you can. You wanted 22 in assets. Okay. Are we assuming an all-in-one loan is equal to an interest-only first position HELOC? If so, Union Bank will do this for your primary residence. I would say, almost a yes. That an all-in-one loan and a HELOC in the first position are very similar. The difference is with an all-in-one loan, you get charged interest like a credit card. So you only get charged interest on the due date, which means that every time you make a payment into the all-in-one loan prior to the due date, it all goes to principal. And then on the due date, you pay whatever the interest rate is on that balance for that day, which could end up being actually less than a HELOC. So for Jonathan, you could evaluate a first and an all-in-one loan before you make a move. I'm confused. Are you saying that all-in-one loan is only for primary, or they do investments also? They do both. They do both. Okay, See, I know so far that all-in-one is as long as your loan, unlike HELOC, is only 10 years, then reapply. Your house has to be already like rented out. Okay. I don't know. Maybe Texas has a rule that I don't know about. Just finished work. How can I watch what I've missed? You can literally just take the little red button and go like that and move it back. You can rewind. Okay, savings, liquid fund. Yep. Okay. Okay. Extra money for unforeseen. Okay. Cool. Got this. Don't say business at all. Yeah. Thanks, sir. You're okay. Very true. Okay, lots of nuggets. Wonderful. Thank you so much. Glad we watched tonight. Figured out we still have some more pre-work to do. The main thing is learn the lingo, please. Thanks. Thanks. Yep. Jonathan, yes. Income was 8K, Denzel. Yep, sorry about that. Okay. This is exactly what I was confused about. So glad to have that clarity for Velocity Banking. Glad I can help you there. If you guys found value in this lesson, at any point in time, you can hit the super chat button and you can give and sow seed into my kingdom, which allows me to keep creating content like this, keep focusing on my craft, keep learning, keep studying and studying and studying and learning, being a good kingdom citizen. Interested much in this concept, God bless, okay? I've used Velocity Banking to get both my husband and my credit up to over 800 and acquired a credit card that works like a line of credit through our credit union for both my husband and I. 5.4%, 30K, and started investing. So Jennifer brings up a really good point that I missed about credit cards. So credit cards, typically, most of them, you can't pay your mortgage with it, right? Typically, most credit cards will not allow you to pay your mortgage, your car payment, your rent, you know, certain insurances, things like that. But there are some credit cards that exist in the marketplace that function, right? Just like Jennifer was saying, that function just like a line of credit. Meaning, you can take your checking account and send your income all to the credit card, and then you can swipe your credit card to pay bills that can be paid with the credit card, and then the bills that typically are not allowed to be paid with a credit card, you can make a withdrawal back to your checking account, and that pays the bill. But when you make a withdrawal from your credit card, no fee. It's like a regular balance transfer. It's like you're writing convenience checks to your checking account. So there's no cash advance fee. So you're not doing a cash advance because cash advance have fees. Plus, Jennifer just said 5.4%. Earlier I said anything below 7 on a PLOC is amazing. You give me 5.4, my God, we're moving. We're moving fast. And she said 30K credit limit. I mean, most PLOCs don't even go to 30, right? By then, you got to be at a HELOC. So this is a fantastic tool. Fantastic tool. Fantastic. Okay. That's awesome, Jennifer. We would like to do that. What you did too. Want to be able to start IBC. Yep. John says, God bless you. If you already have no debts, what would you guys say would be the best way to recapture cash flow and redirect savings more efficiently to leverage income? Personal line of credit or cash value life insurance policy? I will definitely say, Prue, that for sure at some point we want to transition from banking products into cash value life insurance, right? Because I absolutely love how I can just take my savings dollars and dramatically increase the rates that I get. So let's say, for example, Prue, I'll give you an example. Me personally, I'm putting 70 grand a year into my policy, right? But let me think. Let me use a smaller number. Let's say you save. This is what you do. You save 30 grand a year. Okay? So we're just talking about savings. Just savings. 30 grand a year. Divide that by 12. It's $2,500 a month. Okay? Right now, that 30 grand is sitting in either a money market account, a CD, a savings account, a checking account, earning less than 1%, maybe 2%, nothing crazy, right? If you moved it to an IBC, over a period of time, we can be earning 4 to 6% tax-free compounded interest forever. And then you can borrow from yourself and go put that money, that savings, into other locations that can earn maybe a matching rate of 4 to 6 or probably a little bit higher. So what I do personally is I have a account with crypto.com, right? This is the future, okay? It's here to stay. Look, Visa has backed up crypto. Visa. There's no getting around this, right? It's here and it's here to stay. So I am embracing it for the time being. I'm very early in the game, right? Because this card, this Visa is a fairly new thing. So crypto.com is a platform. It's an exchange. I compare it to, say, the stock market, but for cryptos. On this platform, what I do with my savings, the 30K, right? I'll say, let's say we borrow half of that. Borrow 15 grand out, right? And I put it into the crypto. Now, I'm not an expert on crypto by any means, but what I do know is that they've created what's called a USDC coin, which is called a stable coin. A stable coin is a safe digital cryptocurrency that is matched to the US dollar. So the USDC is the United States dollar coin, which is on the Ethereum network, which is backed by Coinbase. Coinbase goes through audits. Coinbase is very solvent, a very reliable, strong. They have the proper amount of coins reserves to match. They're not fractional reserve lending like the banks do with money. This is totally decentralized. And this US dollar coin, I can take my 15 grand and buy $15,000 worth of coins, USDC. Specifically on this platform, the crypto.com platform, I can do what's called staking, right? And I can earn up to 12% max with this credit card specifically, right? So I earn 12% on 15 grand. 15 grand times 12% is $1,800. Okay? You know what I could do? The earnings that I get from this, right, I can continue to feed the beast, where every year I send 30K into this IBC account, take out 15, earn 12% over here, and keep compounding it. So year 2, we do another 15. So that's 30 plus the 1,800 times that by 12%. That's now in year 2, $3,816. This is savings, 12% return, savings, right? And then what I do, right, is I can take eventually, you build it up, I can take a portion of this principal and the earnings, and I can either send it to this card. Remember, this is like a credit card. This is literally like a debit card, and it comes with cashback rewards. And guess what? I earn 3% cash back on all purchases. I earn 10% cash back on gift cards. So what I do is I buy gift cards at locations that I typically shop at. So I'm going to get 10% cash back and 3% cash back in the form of cryptocurrency. So instead of cash back, it's cryptocurrency, which I can then take those cryptocurrencies and stake it and earn more, roughly another 6% if I stake it. So pretty powerful right there. That's something simply that I do inside of my policy, right? That's a great way to recapture cost and leverage your savings. This is money that I don't plan on touching, right? I don't plan on touching any of the money. That's why it's called savings. We don't touch it, so therefore we don't want to use it. So I don't want to put this money in the Bitcoin because it can go up and down and it can fluctuate. So what I do is I just buy a stable coin, I stake it, earn a high rate, I then pump it eventually into this card, stack it up, use it to pay bills. With this card specifically, I get a reimbursement, a 100% reimbursement on Spotify and Netflix, right? So Spotify, I think it's like $11.99 or $9.99 or something like that. So that's say $120 or so a year, and then the Netflix is also like $12 or whatever it is. So I'm getting reimbursed almost $300+, plus I get cash back on the purchase, right? Isn't that cool? So they're reimbursing me for 2 bills that I know I'm going to spend no matter what, and I'm being reimbursed to just use their card. I'm being incentivized to just use their card. That is pretty freaking cool. So if you want to get more information on that, you can totally send me an email in regards to crypto for all my clients. You can send me information, send me questions on that. More than happy to refer you to the platform. You can ask me for my referral to earn a reward when you get on the platform. If you sign up using my code, you get $25 when you first start. So I'll just go ahead and write my code. So you go to crypto.com and then you put in the referral code 6R5KXCUNFK. So all lowercase letters, 2 numbers, 6R5KXCUNFK. You type that in, right? That's my referral link there. To make it even easier, I'll go ahead, type it in. There you go. So I typed it in right there at the bottom so you guys can see that in the chat. We got 109 people in the house. Wonderful, wonderful. Let me keep going through the questions. Wonder if acquiring a HELOC to invest. Crypto's just a thought. Yeah, I would rather use maybe credit cards because 0%, no cost. You mean using a HELOC and redirecting that in crypto? Using a HELOC and no. So eventually, you know, these become obsolete. I'm like full cash value, savings dollars. I'm not putting my savings into a HELOC or PLOC. It's just money that I save. Establish the policy, borrow it out, goes back to my checking account, put it in crypto, stable coins, earning a 12% rate. You can't beat 12%. I mean, come on. That's pretty good. Johnny says, let's get those likes up. Show the man some love. Yes, hit the like button. I would appreciate that. Helps with the algorithm. Super chat, $5 from Mama Bean. Thank you for what you do. Blessings to you. Thank you very much for giving in the kingdom. Jamal, Fed Choice Credit Union in where is that? MD? That, I forget what state that is. Has PLOCs with rates below 7% with open-ended terms. That's phenomenal. What credit union is that, Jennifer? What type of credit card is it? Okay, we got a question. You know, somebody was asking a question there. Terry says, couple of IHA moments tonight. Very good. Terry gave $49.99 in the kingdom. Thank you very much for giving and blessing and sowing seed. The Voyager app is amazing for crypto as well. 9% APY for the USDC compounding interest. There you go. So Voyager app, crypto.com, Coinbase, these are all crypto exchanges that will provide a staking rate on your stable coins. Please remind me what CVLI stands for, Cash Value Life Insurance. There you go. That's the link. Check it out. Thank you. You're incredible. Awesome. So I got to the end. We're about to break 2 hours. I hope you guys enjoyed this. All right, let me know in the comments. Did you guys have a blast? I mean, was this like, oh, you know, like, okay, I finally get it. I'm gonna move forward with this, and I'm gonna like 10x. Right? We're gonna have some fun. So with that being said, that is Velocity Banking Fundamentals. Take it. You might have to rewatch this 4 or 5 times for it to really click. Take your notes, pause the video. You'll see me erase. Pause the video, write it down, take your notes. Be very committed to what it is that you want to do. Is it pay off debt? Is it 10x invest? Is it debt leverage? Build credit, build business credit? Whatever it is, I have a ton of links in the description below that talks about building your personal credit, building your business credit, 10xing your business, right? Marketing, email marketing, landing pages, sales, follow-up, communication, public speaking, right? I got a lot of different courses that you can take, a lot of different angles, a lot of different approaches. Ready for your cash value life insurance policy? You want to get that rolled? There's a link right in the description below. If you're not ready for any of that, just get on the email newsletter so I can start curating my YouTube channel. At this point, there's well over 500 videos on my channel. So you could probably get lost in the sauce, I'm not going to lie. I've always given the guidance to people is to just go to the very beginning to learn about my character, how I operate, what I was doing. You can see the evolution of the channel, what it increases to and what we continue to talk about. You're going to notice that as I continue to put out more content, I'm starting to really lean into the 10x thought process, the 10x mindset, expansion, big thinking. I can only talk about velocity banking for so long. I can only talk about debt snowball for so long. It's the basics, fundamentals of personal finance, financial literacy. I want to start leaning into financial intelligence, which is a higher level than financial literacy. Financial intelligence is being able to truly understand how to multiply wealth, how to break free from the matrix, so to speak, that the systems that get put on us, how to speak the language, how to get into the rooms of what multimillionaires, multi-billionaires are doing with their money, right? To really understand the difference between traditional ways of creating wealth, non-traditional ways. They both somewhat achieve the same goal. It's just a matter of which one is more effective for me. For me, your finance geek of the 21st century, the only thing that makes sense to me in the 21st century is to cash flow. I would rather have consistent passive residual royalties and passive income through cash flow and dividends, because it's taxed at the lowest rate. I would rather have that than $5 million in net worth in my personal name that I'm going to get taxed 30 to 40%. I would rather have $50,000, $30,000 a month in cash flow in passive residual royalty, capital gains, dividends, income than $5 million in my personal name. Because the rate that I'm going to get taxed at is basically what I would have in cash flow. But then we have to realize is that cash flow, that passive income, write off, write off, write off, write off this, write off that, write off this, write off that. And guess what? When I write off all of that, I pay the IRS only what is required according to the tax code. And then I keep all the money to me that allows me to give more into the kingdom, way above the standard 10% rule, way above standard tithings. I can start giving 15, 20, 35% giving, right? And I can do it without blinking my eyes. I can do it with my eyes closed, okay? And it not hurt me in any way. Because guess what? My goodness, when I give from the heart, I get a 10x return because I'm serving an almighty, all-knowing being that's immaterial, right? Invisible. It has no restriction on space, time, matter. It created all of it, right? So now I'm serving this being that's spaceless, timeless, right? Irrefutable, all-knowing, all-powerful. And I've got this constitution that's telling me that I'm going to get a tenfold return on when I give. So as long as I figure out how to maximize the governmental system that I live in as an American citizen, while also having dual citizenship in the kingdom, right? And I figure out how to maximize the governmental system in which it was originally designed to benefit certain people, people who build businesses, people who are entrepreneurs. If you stay as an employee, if you stay as a servant, you run the risk of potentially becoming a modern day slave. And that's a very powerful word. It's a trigger word, it's an emotional word that can hurt a lot of people. But if you stay just as a servant, right, you run the potential risk of becoming bound to the governmental system that you live in. No matter what country you live in, you become bound to that government. That government becomes your God in a sense, because now you have to rely on the Social Security, you have to rely on stimulus checks, you have to rely on SBA loans, you have to rely on banking products, you have to rely on a credit score, you have to rely on the pension plan, you have to rely on the 401k plan, and the this plan, and the that plan. That's what you have to operate out of. As a kingdom citizen, I represent another nation, another kingdom that does not have any type of restriction on the citizen. I simply follow principles, moral values, rules, processes that benefit me in a dramatic way. I'm now able to live above the governmental system because I cannot be bound by a man's system, by human. If a human created a system that oppresses people, or even if it benefits people and it has these different views, at the end of the day, if it does not represent the kingdom, then I cannot stay there forever. So I cannot stay as an American citizen that just has a job forever. At some point, I need to provide value into the American system, into my government. I need to establish my own governmental rule in my household with laws, ethics, values, a mission, a purpose, a vision to move forward. I need to provide a business, a product, a service to the governmental system, because when I do that, I now become an asset to the government, not a liability. If I remain as an employee and I have a job, I am a liability to the government. They are liable to pay my pension, my Social Security, my health care, Medicaid, and and Obamacare, and I'm strapped to the pension plans and the 401k plans and stimulus checks and SBA loans. I'm liable. The government is liable to me. I'm a liability to them, not an asset. How valuable is that to the government, right? Versus I can become more valuable and not only just be an employee, but also have a business and become an asset to the government, so that in the event the government imposes on my, say, human rights, my beliefs, my faiths, my morals, my values, my missions, at any point in time, if I don't feel like a true American system, if I feel that the government is now deviating from kingdom principles, morals, and values, guess what? As a business owner, I could jump ship. I can go to another country where they're going to praise my authority, where they're going to respect my values, right? And you want to have that flexibility because you really don't know what can happen on a big scale, right? You don't know what powers are coming up in the economies. You know, if you don't study this, if you don't study your economy, the U.S. economy, if you don't study where we're at in terms of powers, right? You got Russia, China, right? If you don't study who the allies, who the enemies, who the adversaries are, you could be a little blindsided. You don't want that, right? You don't want a COVID to knock you out. You want it to present an opportunity. COVID provided an opportunity to me to expand and think big and scale up. Whereas most people, they went in, they covered up, they got scared, right? And you can't operate like that when you're a kingdom citizen. If you're a king or a queen, you solve problems. That is what a king and a queen does when they are running an operation. When they are running a kingdom, you are solving problems. The more problems you solve, the more citizens, the more people become citizens in your kingdom, and they are loyal to you, and you establish a decree. You establish a constitution where people unite and they operate and they move forward. With that being said, I will leave you with that. God bless you. Enjoy the rest of your evening. God bless, and we shall talk soon.
remember you saying, hey, I know something's there, like with this policy design, as you were digging into it really from the consumer side.
I guess you could say there wasn't a big amount of creators on YouTube that were focusing on velocity banking, personal finance, things like that.
Like you said, it doesn't matter who you get the information from, as long as you get the information and you take action. That's all that we ask at the end of the day, so that you can build wealth for your family and your family's family.
Hey, here's a taste. Now, if you're feeling it at all, then go take a deeper dive. Go start doing your research. Start listening and learning about this whole concept